So, retirement planning has always involved balancing growth, income, and protection. Yet, though, in recent years, with market swings, shifting interest rates, and longer life expectancies, many thoughtful investors have begun to question whether traditional stock and bond mixes alone are going to be able to deliver the stability that they need. Now, one approach that receives less attention than I think perhaps it should is investing in mortgage notes. This is not about chasing high risk speculation, it's about accessing collateral based cash flows that have served institutional and private investors for generations. Now, with these types of investments, you're often operating outside of the daily volatility of public markets. So, today I want to explore why it is that some experienced investors are allocating a portion of their portfolios to performing mortgage notes and how the strategy functions in practice. And I want to cover the discipline framework that I believe is required to evaluate it properly. So, at its core, purchasing a mortgage note means stepping into the role of the lender. You acquire the right to receive the scheduled payments on an existing loan secured by real estate. The homeowner continues paying their mortgage as before. The difference is that these payments are now flowing to you. So, in the current environment, with 30-year mortgage rates hovering around 6.3, 6.5% in mid 2026, doesn't seem like they're going down anytime soon. Season notes purchased at appropriate discounts or terms can generate yields that sit meaningfully above many traditional fixed income options, at the same time that remaining tied to tangible property collateral. Now, this creates a distinct income layer, monthly cash flow that does not require selling shares during market downturns. So, if you're a retiree concerned about, say, sequence of returns risk, the danger of withdrawing from a declining portfolio, well, such predictable streams can act as a form of a ballast, if you will. Now, what makes notes particularly interesting is their hybrid nature. So they offer higher potential cash yields than treasuries or investment grade bonds in many cycles without the operational demands of direct property ownership. No tenant calls at midnight, no surprise repair bills. The borrower remains responsible for the home. Now, unlike corporate bonds, your claim is backed by a physical asset with long term intrinsic value. In periods when inflation erodes purchasing power or when equities feel stretched, this real estate linkage provides a different correlation profile than many portfolios lack. None of this is without trade offs, and any credible discussion must address these directly. So, liquidity stands out as the most important. Notes trade in a specialized secondary market rather than on public exchanges. So, they require a longer time horizon. Position sizing matters. Most thoughtful investors limit alternatives like this to a modest slice of their overall wealth, maybe perhaps single digits to low teens percent, depending on their liquidity reserves and their overall plan. Credit risk exists, yes, of course. Strong equity cushions in the underlying property, ideally well above 30 or 40% after your purchase price, provide the primary protection. So, diligent review of borrower history, property condition, title, and local market dynamics become essential. So, many investors mitigate this through diversified note portfolios or established servicing partners. So, prepayment risk also plays a role. Borrowers may refinance when rates fall, returning principal earlier than expected. So while this is generally positive capital return, it does require redeploying that capital thoughtfully. Tax considerations deserve attention as well. Interest income is typically ordinary, though discounts and structuring details vary. Professional tax guidance is a non-negotiable thing. So what draws many late career or retired investors to this space is the psychological benefit. So there is a certain quiet confidence that comes from owning income streams backed by American homes and responsible borrowers. It's not flashy, but It has proven resilient, right, through various economic cycles. So if you can imagine layering this alongside your Social Security, your bond ladder, and equity holdings, what you're doing is creating multiple income engines that respond differently to inflation, rate changes, and market stress. So this is the art of true diversification, not just different stocks, but different asset behaviors. So, in my analysis and experience with note investing, the real opportunity lies in disciplined execution rather than any single deal. Start small, verify every detail, build systems for ongoing monitoring. Treat it as one thoughtful tool within a comprehensive retirement architecture. So on the site, I maintain updated resources, including evaluation checklists, yield modeling tools, and comparisons across income assets. So these are built for investors who want to go deeper without relying on oversimplified promises. So let me leave you with four practical observations. First, mortgage notes can add a collateralized income component that complements rather than replaces traditional investments. Second thing is success hinges on rigorous due diligence, conservative structuring, and appropriate portfolio allocation. Third thing is this approach rewards patience and process over timing and speculation. And fourth, it works best when integrated into a full financial plan reviewed with qualified advisors who understand alternative assets. So the retirement landscape in 2026 and beyond will reward those who thoughtfully expand their toolkit while maintaining discipline. Mortgage notes represent one such option, right? Overlooked by many, but quietly effective, right, for those who study the mechanics. So thanks for investing your time here. If questions about evaluating notes or building resilient retirement income strategies come to mind, share them in the comments below or visit the resources on the site. There's a link down below. For more measured discussion on wealth building and retirement, consider subscribing. Steady, informed progress remains the most reliable path forward. I'll see you in the next video.